Hi, good morning, everybody, and welcome to our Let's Talk About the Basics of General Financial Planning session, which is part of our Talk Money Week webinars. And that's going to be delivered today by Dan Birtles from Quilter. Just before we go on to the presentation, for those of you who don't know about the charity, I just want to say a little bit about who we are and what we do. Our vision is to be a supportive community in which everyone has the chance to live their life to the full. We offer a range of services and support. This can be online and offline, and it could be from ourselves or in partnership with a range of other specialist organisations. It's important to say that each service is dependent on your situation and your eligibility, and we will often check this either through your national insurance number or through your payslip. If you're not sure whether you're eligible or whether it's something we can help with, the best thing to do is to contact us and ask. We know that life isn't black and white, and neither is our offer of help, so we do look at everyone on a case-by-case basis. In terms of who we help, all civil servants, current, former or retired, and their dependents can seek the charity's help at any time. Even if someone leaves the civil service, they're still eligible to come to us for help. And by dependents, we mean people who are financially dependent on you. Although the charity is funded by civil servants, you do not need to have donated in the past to apply for help. So we're not a membership organisation. Just by being or having been a civil servant, you're already part of our community. So I'm now going to hand over to Dan, who is going to be talking to us about the basics of financial planning. Thanks, Dan.
Thank you. Thank you very much. So I'll just share this screen. Just let me know if you can see that okay.
That's fine.
Yeah, brilliant
Thank
stuff. Great. So good morning, everyone. Welcome to the webinar this morning. My name's Dan Birtles. I'm a financial advisor with Quilter, and I've been with Quilter for about 6 years now. So hopefully you'll find this webinar interesting, and hopefully we may be able to help you moving forward. So this is called Creating Your Tomorrow, and you're in good company. Quilter Financial Advisors, we provide financial advice to millions of individuals who form employee organisations and affinity groups like yours. And this just gives you an idea of some of the members that we help and support. We have over 30 partner organisations, and that's increasing all the time. And we work with each of them to deliver appropriate and relevant financial solutions. We're looking to give members sound financial advice and a plan moving forward to help them reach their financial goals. Who we are. So these organisations know we are well placed to support their members to achieve their financial goals. And that's because we can give you, number one, comprehensive services that suit your needs. 2, a strong support network and breadth of expertise, so you can feel reassured you're partnering with professionals. And 3rd, great value for your investment with our strong buying power. We can help at every stage of your financial life. So obviously starting off, student loans, purchases, we can help with things like mortgages, investment plans moving forward. We can reshape your savings potentially if you're looking to start saving early for later in life. And as you move up, we can help you at every age, every step of the way, really. So this just gives you an idea of some of the phases where we can help and support you. What we'll give you in this presentation, by the end of this session, you'll have a better understanding of the basics of financial planning and planning for your future, and the essential steps to understanding pensions, mortgages and protection, and planning for what's ahead, and the avoidable threat to your plan. The value of pensions and the income that they produce can fall as well as rise, so you may get back less than you've invested. Okay, so the basics of financial planning. So I suppose the two questions there is when to retire and how to retire. And financial planning helps you achieve a comfortable lifestyle and ultimately is the financial preparation for life after work. So why should you do both? Well, you want to make sure that your income lasts throughout your entire retirement and also thinking about the quality of life in retirement. The fact that you're here today is a great start. We have three different scenarios here. So we've got a young future thinker. So this person's looking to lay solid foundations to achieve financial security and flexibility for the years ahead. A mid-career professional looking to make the most of remaining years in work before retirement. And then a responsible pre-retiree. So I want to be empowered to make informed choices that pave the way for a confident and stable retirement. But ultimately, the time to start planning is now. Life expectancy is increasing. And just to give you an example here, so a 51-year-old woman will see these types of results. If you used to have a look on the Office for National Stats, they have this expectancy calculator. So the average life expectancy for a female of 51 years of age is 87. However, there's a chance that you could live longer. There's 1 in 4 chance you could live till 95, 1 in 10 chance to live till 99, and a 7.6 chance that you will make 100. So it's worth having a look at this yourself. If you search for ONS life expectancy online, there's a calculator there and it will give you an idea of potentially how long you're going to live to. So thinking about retirement, it's a major step, isn't it? You've been working all your life, you're approaching retirement. It's normal for people to feel that their income might be inadequate in retirement. You know, am I going to have enough money to survive in retirement? A couple of examples here. So if we take a late retirement and an early death, we'll just simply squeak by. Or you can afford to retire at 65, so but you'll need to die at 70. So running out of funds, these are the main concerns for people as they approach retirement. So the benefits of starting now, I suppose, is if we look at an example of a goal, so this person's goal is for the investment to be around £100,000 in 30 years' time. So to reach this goal, here's what you would need to do. If you was to start saving today, £203 a month, the longer you leave this, I suppose this is what it's aiming at here, is you would need to obviously start saving at a higher rate. So it's important to try and do things as early as you can. Why should you plan for retirement? What's your why? And here's what lots of our customers say. Well, importantly, I want to plan for retirement for financial security. I want freedom and flexibility when I retire. And I want to maintain the lifestyle that I'm used to financially currently in work in retirement. I want to avoid becoming a financial burden on other people. And I'm hoping to live happily in retirement and have a long retirement and have the money to cover it and to do things what I want to do. So different places for your future income could come from predominantly pensions. So what do you have in terms of your pension? Have you got national insurance contributions up to date for your state pension? Do you understand your workplace pension? And do you understand the options around your workplace pension? And do you have a private pension? Potentially, you may have worked somewhere else previously, and you may have done savings elsewhere. So it's understanding, I suppose, what you have it as a collective in terms of your pensions. Other sources of income. So what do you have? Do you have savings? Do you have investments? Do you have potentially property that will provide an income? Do you have financial support at the moment? So basically what we do is we, as financial advisors, we try and put all these pieces together for you to help you plan forward for retirement. In terms of pensions, you may have accrued benefits with former employers or individual personal arrangements. And these old pensions obviously do not die, so they should still have a value and they can be traced. These may be from former employers, from private or public sectors, additional contributions, AVC or FSVC, which is additional voluntary contributions or freestanding additional voluntary contributions. You may have an individual private pension, e.g. a personal or a stakeholder pension. And we can obviously offer help to your partner as well. So your partner might be in a similar situation here. And because we are working with you via the union, it does offer the opportunity for us to support your partner as well. So that's something to bear in mind. We can help with things like tax. So your different sources of income are most likely to be subject to tax. And thinking about this and planning for tax will help maximise your finances during your retirement years. So how much tax might I have to pay on my retirement income? And how much money can I take out of my pension without paying extra tax? So these are some of the questions that we can help and provide answers. A concern for most people approaching retirement is understanding how the income works, the different types of income, and how that associates with tax. And I suppose it's looking at tax efficient ways of taking your money in retirement. And how much money can you take out of the pension without paying extra tax? So these are kind of things we can support you with as you move into retirement. So different types of pension schemes, pension jargon ahead. So yeah, this pension terminology can be very confusing. It can be hard to understand what it all means. Natural retirement date, flexible access drawdown, for example, annuity, what's an annuity? What does the annual allowance mean? What does uncrystallised mean? All these different things, it gets very confusing for members. I've been studying finance for 15 years and I still, some of the things I see, I still get a little bit confused with myself, to be honest. But we're here to support you and help you understand what all these different things mean. And let's see, so in the UK, there's basically two different types of pension schemes. So there's a defined benefit scheme, which is a form of a final salary, or a care scheme. Care is career average revalued earnings. So these are pretty much guaranteed payments. So once these pensions come into effect, in essence, they will keep paying you every month for the rest of your life. These types of pensions, to be honest, we don't see as much anymore. These are an old type style pension, and these pensions are superb because they keep up with the cost of living. So they have inflationary increases. They provide security for you moving forward. You know that when you retire and the pension comes in, this pension is going to keep coming in as an income payment would on a monthly basis. So it gives members peace of mind moving forward. The second type of pension is what's called a defined contribution pension or a money purchase pension. And in essence, this offers a bit more flexibility with less guarantees. So we can move on and have a look at what this means. So this is the defined contribution scheme, known as a DC scheme. Basically, what you're doing is over your working life is you're creating a pension fund or a pot of money. You have contributions going into this on a regular basis, and then that money that you're paying in is effectively invested and it's return based. So the pension providers are looking to get growth for you year on year, building up this pension pot. The pension fund or the pot can be used to secure an income in retirement. So that's an option. And you may have heard of an annuity. An annuity basically is where you've got a lump sum of money you hand over to an insurance company, and in return, they will provide a monthly income for you, either based on a set term, or they can actually pay you for the rest of your life, like a final salary in essence. The main options for a defined contribution pension for income would be the annuity, as we've mentioned there. Flexible access drawdown. This has become very popular with members because in essence what it does, it gives you more control over your pension income. So drawdown and or third way contacts. So the holder can decide if they wish to provide a spouse's pension. So again, it gives you more flexibility as a DC holder. There is a tax-free entitlement to the capital, so usually up to 25% of your defined contribution pension, you will be able to withdraw tax-free. And you do get a lot more in terms of flexibility through what's called pensions freedoms, which basically means you can access the pension from a certain age. It's 55 at the moment. It is actually increasing to 57 in a couple of years. But from that point, you can access the pension. You have choice of how you want to access the pension. So you could take a tax-free lump sum. You could take a taxable income with a lump sum. There's all different things available. Again, members get a little bit confused with it because it's not something that they're used to, and this is where we can provide support. We can break down the options for you and show you exactly how to utilize the pension in a tax efficient way. On the flip side, if you're looking to start the journey and you're looking to you're thinking about a different type of retirement income rather than just the final salary option, then we can give you direction on what to do and how to get the best out of a defined contribution pension. Pension income. So a final salary pension, main contributing factors is the year's membership. So how long have you been a member of the scheme? And the pensionable salary with an accrual rate of an 80th. So the final salary pensions, to break that down, are pretty much based on how many years you've been a member, and your salary and the accrual rate. So there's three different points there to a final salary. Again, it can be quite difficult to understand. You may see a pension forecast available and you may look at it and think that doesn't make any sense to me whatsoever. We can look at that for you. We can help you understand what the final salary options are, and we can break things down for you. The care-based option, so this is on pensionable salary over a certain number of years, and this is indexed. So this is basically, it has inflationary proof rises within the pension. So again, a little bit complex, but basically it's a form of a final salary, and it's worked out on what you've been earning over a number of years. And again, we can break this down for you when we can look at different options with this. What you generally find is the old type pensions will come with an automatic lump sum. The newer type final salary pension, i.e. the care, doesn't actually come with an automatic lump sum, but it will give you choices going forward. And I think that's where people get a little bit confused. You know, should I reduce my income for a higher lump sum? These are the questions that we can basically demonstrate. We can show you how things would look if you was to take a maximum lump sum, and how that would look for your income going forward as well. The defined contribution, slightly different. So this is, as we said, a pot of money. This gives you more options going forward for your income. You may not need an income. You may just want flexible access in terms of withdrawals. Again, very popular at the moment, the defined contribution. The state pension, so this will provide an additional guaranteed income, and this is based on your national insurance contributions. So it's important just to understand where you are in terms of, have you made enough national insurance contributions over your lifetime to ensure that you are getting the maximum from the state when you do retire. And you can quite easily check that. Actually, if you type into Google, check my state pension, there's a government link there. I think it's the top one. If you can access that, you need your national insurance number, but it would actually show you exactly how many years you've paid into your state pension. So that's good to have a look at. And I suppose the main question for people approaching retirement with the pensions is, will your pension be enough to continue the lifestyle that you're used to? A lot of members are worried that they're not going to have enough money when they do retire. So we can kind of help you with forecasts, I suppose, and we can show you how your retirement will look based on the income that you've accrued already. So that's something that's quite popular with members. We use a cash flow. That's the name of that. So it's a cash flow forecast. So pensions, freedom and choice. Basically what this means is it gives increased flexibility and options for members who have a DC, or defined contribution scheme. Complete flexibility once the holder gets to age 55 at the moment. 25% of that pot would be tax-free, and the remainder would be taxed as income. This is where members get a little bit confused with it as well. You don't necessarily have to take the full 25% tax-free if you want. You could take smaller amounts. So you could take 10% of the tax-free and hold 15% back in the fund for a later date. You can take a mixture of tax-free cash and taxable income over a set period of time. So again, we can help you, and I suppose it depends on your current tax situation when you do retire, so we can give you the best options moving forward there. On death of a pension holder with the DC scheme, the unused funds can be passed through generations or to designated beneficiaries. This is something that you probably wouldn't get with the other type pension, unfortunately. With the defined benefit pension, you generally get a percentage of that pension would be passed on to spouse and partner. But the actual defined contribution pension means that you can secure that pot of money. In essence, if something happened to you, you can pass it on to your spouse, partner, or even beneficiaries, your children, for example. Potential transfers from a defined benefit scheme is an option. Not something I would generally recommend, to be honest with you, because you've built up a pension over your working life that's going to provide a guaranteed income for you when you do retire. So to give that up is it takes careful consideration, and the regulator is very keen that a full advice process is completed. There are pros and cons, I suppose, and if that's something that you are considering, it's something we can help you with. Lifetime annuities. So the annuities is kind of a form of a guaranteed payment for you. And there are different types of annuities. So depending on your circumstances, if, for example, you may have a health problem, the annuity might be an option for you as a result of that. So again, we can go into more detail and give you different options there. Just highlighting the bottom, as we mentioned there, transferring out the final salary scheme is unlikely to be the best interest of most people because it is a guaranteed payment. It's going to go up every year. So for you to sacrifice that needs very careful consideration going forward. So what options do pension holders actually have? Well, they have flexible access drawdown, known as FAD, where you can, in essence, when you retire, take your tax-free cash as a lump sum, and then it will provide an income with the remainder. They have what's called uncrystallised fund pension lump sum, or UF+. Again, this is where it gets a little bit confusing, but in essence, what you can do is take tax-free payment as part of an income, or you could take the entire fund if you wanted to. And then the third option there is an annuity, as we discussed. Again, you can take the tax-free part before the annuity income comes in, if that makes sense. There are many different benefits and types that can be selected, e.g. index. So in essence, you could have a regular payment coming in, and that would keep up to date with annual inflationary increases. So your purchasing power is staying strong in essence, rather than just having the same amount coming in over a 10-year period, for example. So there's different options available on there. Defined contribution death benefits. So what happens on death if all of the pension fund is not used up? Yeah, this is a very popular question. So with the defined contribution scheme, the pot of money in essence that you've built up, if you die before 75, the benefits can be passed on to designated beneficiaries tax-free, or free of tax, I should say. And obviously then if you survive over 75, you've got a pot of money left, and then you pass away, your beneficiaries will receive this, but they will be taxed at their own marginal rate. Again, that can cause problems in the future if you've got, say, for example, a son who's maybe on the cusp of higher rate tax band, for example, and then they receive these types of benefits. Potentially, it's going to push him into the higher rate band. So again, there's advice that we can give you there that kind of mitigates that, for example. So the pension tax-free entitlement, so what is that at the moment? Is this subject to change? Well, we're not really sure what's going on at the moment. Obviously, like everybody else with the budgets and stuff, we don't think this is going to change, because at the moment you are able to take 25% of the capital value within a DC pension scheme. If you've got a final salary scheme, you can in essence also surrender part of the income for a lump sum. So in essence, typically what they're looking at here is a ratio of 12:1. So for every £1 of income that you are willing to surrender, you would get a £12 lump sum. Generally, 25% of a pension fund is tax-free. However, depending on what type of pension you've got, and if you've got pensions going back quite a long time, maybe 80s, 90s, there may be a chance that that actually might be more than 25% tax-free within the scheme. So again, we can look at that for you. I have seen some pension schemes paying up to 50% tax-free cash, depending on what type of scheme it is. So again, that's something we can help you with. Some of the questions that I suppose you need to consider. Most people, most members, I think, when they approach retirement, automatically, and that, it's probably speaking to colleagues and friends, family members, they generally opt for taking the maximum tax-free cash out straight away. Most people I speak to say, I want to take the maximum out. So it's just understanding, I suppose, should you take the maximum tax-free cash out? And there's things to consider here, like your age. So if you're retiring early, is it a good idea to take the maximum out, knowing that you're going to be more dependent on the pension over a longer term because you're retiring early? Your health, longevity of the family, dependents. If you do take the money out, what are you going to do with it? One of the worst scenarios, I suppose, is taking money out of the pension, which is an investment environment, if you like. So it's geared for growth, and then just putting it into your bank account, which we do see quite a bit, unfortunately. Putting the money into your bank account is, well, you're exposing it to erosion with inflation. So in essence, the longer it's in your bank account, unfortunately, it's actually losing money. If it's kept in your pension scheme, it's actually gaining money. So it's understanding, do you need it? And fair enough, some people do. They retire, they want to pay mortgages off, for example. They want to pull that lump sum out. So again, we can give you options and give you some advice around that. Some people want to utilize the lump sum as an investment opportunity, so they might not necessarily need the lump sum when they initially retire, but they do want to draw that money out of the pension, and then they want to look at potentially investment opportunities going forward. That could be for things like inheritance tax planning. It could be for medical care planning. It could be, you could be thinking about intergenerational planning, so maybe preserving this money for your children or your grandchildren going forward. So again, that's something we can understand and work with you. Taking the money out of the pension might give you better access, more flexibility. There may be a need for an extra income. You may have other pensions with employers, private pensions, as we mentioned before, state pensions, your partner's pension, spouse's pension. But it's important, I think, to have a look at taking some financial advice around this before you retire. Because with all these different types of pensions over the years and different types of schemes, different types of benefits, we can ensure that you're getting the right financial advice going forward. Okay, so we'll just have a quick look at mortgages and protection. So pound for pound or additional reduced borrowing. So I suppose it's about knowing and understanding your existing mortgage deal. When does it end? Is that going to conflict with potentially other retirement options? If it does, what happens then? I suppose, what do I do? Do I use my pension lump sum to pay off the remainder of the liability of the mortgage? Is that something I should be considering? Again, we can give you advice with this. Is the things that you could do now, so looking at your mortgage balance and maybe thinking of retiring in 5 years' time or 10 years' time, what could you do now to reduce that balance in time for when you do retire? And what are the sensible options moving forward? Looking at new deals, if you're quite young and you've got plenty of time left on your mortgage, when's the best time to have a look at new deals? Again, we can source mortgages as a finance company, so we can help you look at the best deals out there. It's important to get advice. Most people just tend to keep going back to the same company year on year, and unfortunately that's not cost effective, and you're not getting the best out of your mortgage, which ultimately means you're paying more money, and it means that the mortgage is going to be there longer. So it's important to get some advice. So we've got to think carefully before securing debts against your home, and your home may be repossessed if you do not keep up repayments on your mortgage. Yeah. So further advances, should you be considering your existing lender? What options do they have? Home improvement quotes, costs of additional borrowing. Is there alternative finance options available? sub-account on additional borrowing rates, or full applications, affordability and credit checks. So if you're looking for more money with your mortgage, depending on what you're looking to try and do, again, we can help in this area, and we can look at different types of quotes for you, different repayment terms, and we can source the market in essence and make sure you're getting the best options going forward. If you're thinking about moving home, valuation of your existing property, understanding what the costs are of moving, allowing any work or unexpected costs, considering those as well. Looking at the terms of your existing mortgage, would you face an early repayment charge? A porting option, can you move the mortgage onto a new property? Understanding your current deal, what exactly is your current deal? What can you do with it? What can't you do with it? We can help you with that. Working out budget and a price range in detail. Again, this comes through via the cash flow, the income and expenditure. Mortgage providers predominantly now a large part of their assessment is based on affordability. So we can help you put things together for the mortgage provider. Secured agreements in principle, and again, seeking professional advice. So suppose whatever it is you're looking to do, maybe with your mortgage, remortgage, further advance, moving house, we can agree a budget, affordability and borrowing capability, understanding what your price range is, and then we can work with you and put a plan together. Most mortgage offers are usually valid for up to 6 months. Okay, so where to go? So there are thousands of mortgages to choose from. You've obviously got high street banks, building societies, online lenders. We effectively, we are a broker. We don't work for that specific lender, and we can therefore source mortgages from the whole of the market. And in essence, what we can do for you then is we can find the best deals for you, and help you then gain that finance with that particular company. So that's the advantage of working with us. Your home is at risk if you do not keep up payments on your mortgage. Yeah. So what would you do if you have trouble in paying your mortgage? So the first thing to do is contact obviously the lender, work out what you can afford to pay back, and discuss ways of making those payments. You can speak to a debt charity or citizens advice. Some people turn to financial advisors for this as well, and this is where we can help you and give you some ideas and support in this area. And then we'll just have a quick look at protection. Financial protection. So this I think is something that's overlooked by a lot of people. And then when you have conversations down the line, people generally say to me, I wish I would have done this earlier. So this is something to consider. There's something that's quite important. But I suppose, how would you pay your bills if you were unable to work through illness, through disability, or through an accident? Your employer would obviously pay you a certain amount of money for a certain amount of time, but what happens after that point? This has a knock-on effect with retirement planning, believe it or not, because when people get to that point and they need additional income, that's unfortunately then when they look at things like the savings, their investments, and withdrawing at this point in time then affects a later point in time. How would your family survive financially if you were to die prematurely? So if you're the main kind of breadwinner in the family and something happened to you, what would happen to the remainder of your family in terms of finances? If employed, your employer may provide a degree of protection, but would that be enough? So typically you would probably get maybe 3 months full pay, 3 months half pay. What happens then after 6 months? What would happen to your mortgage? So these are the questions, unfortunately, that come to light generally at the wrong time. So this is where we try and identify it before it actually happens. Self-employed, how much state support would you actually get? Not a lot, unfortunately. So it's about protecting yourself and protecting your family. So where are the gaps in your existing protection? Do you have protection? If you was to become critically ill, if you had an accident, have you got something in place now that would compensate your financial situation going forward? Do you have debts that you need to protect? So again, I suppose the big one is the mortgage. If something happened, have you got something in place to make those mortgage payments for you? Are you prepared for the what ifs? You know, most people, and I've been guilty of it myself in the past, and say, well, it won't happen to me. I'm not really concerned about it. Unfortunately, when it does happen, that's when it really hits home. Have you considered the evolving circumstances? So if you may have protection in place at the moment, it may have been in place for a long time. Is it still adequate for where you are now as things have evolved over your working life? In case of death, short-term or long-term illness. So these are the type of benefits that we would look at. So term assurance, family income benefit. So potentially you could have cover in place if something happened to you, an illness, for example, you could receive either a lump sum or you could receive an income over a period of time. Whole of life protection, if you passed away, what would happen to your family members, to your children that you're leaving behind? Well, you can protect those through having life insurance. Income protection, this is quite topical at the moment. So like you say, if you're off work for a sustained period of time, and then the benefits from your employer expire, so potentially after the 6 month point, what happens then? So this income protection is very topical at the moment. A lot of people are looking at protecting their income. I think this came in more from COVID, the COVID era, to be honest with you. So we're seeing a lot more people contacting us now when they're looking for income protection options. And then you've got the critical illness cover, which again, if something happened to you, potentially that lump sum payment coming in could take a lot of stress out of what is a very stressful time because of the illness anyway. So it's protecting your finances. A lot of members are quite concerned and think it's too expensive, and I'm not paying, I'm not paying this much for this. But I think once you understand the benefits and you understand what protection it would give you, give your family, for the price of, a couple of bottles of wine a month, you could really make a difference going forward. If something should happen, that money will come into effect, and it will actually protect your retirement income going forward as well in some circumstances. So it's really key to understand your protection. This is a big one at the moment, as we mentioned there, income protection. So what if you're off work longer term through accident or sickness? So what this will do is this will pay a tax-free income linked to a percentage of your salary after a pre-selected deferred period. So we generally look at, depending on what's going out, we look at maybe 60-70% of what your normal income is. This then takes the pressure off, and it would allow you to pay your bills and give you a certain standard of living while you're going through this sickness period, for example. Deferred period, so the longer you defer it, so you may be able to defer this for 6 months. Like I say, your employer may be able to pay you a certain amount while you're off. And the longer you can defer the period, the actual cheaper the cover is. Benefits can rise each year by inflation or a fixed percentage, so there's flexible options on what type of cover to have. Unfortunately, some of the sickness and illness conditions are not kind of short term, they are long term, may go on for a number of years. Some unfortunately go on for the rest of that person's lifetime. This type of cover will give you protection. So income protection can effectively, in some cases, pay you for the rest of your life if something was to happen. Or you could maybe look at a short-term option, depending on what you want to pay. and maybe say, well, I want income protection to come in for 12 months or 2 years from when my employee benefits finish. And again, it just gives you that peace of mind and security going forward. You can choose a policy that pays benefit on an own occupation basis. And again, so the criteria for income protection, they look at what do you do. So obviously, if you're doing a high risk type of work, manual type of work, for example, against maybe a clerical type of role, this will reflect on the premiums and the risks going forward. So we can do this assessment for you to make sure that you're not overpaying on your premiums. And we can review the amount for which you're covered regular as well. So some people may have set this up maybe 10 years ago. And it may not be adequate now, unfortunately, but people think that, well, I've already got it, that's fine. Well, it's worth checking and just, potentially it could be a lot cheaper now with an increased benefit. So these are the reasons why it's worth looking at. That goes for life cover also as well, critical illness cover. If you've got cover in place and you've had that cover for a number of years, maybe it's worth having a dig through the records and speaking to us, and we can review it with you. Critical illness strikes but you survive. So what would happen? Well, this would pay a one-off tax-free lump sum. The payment of the lump sum is not linked to the ability to work, and it's not linked to any employer benefits as well. So this is quite popular at the moment, having this type of cover in place. ABI core and additional illnesses covered. So basically what that means is that the providers are open to offer, I suppose, bespoke type of cover. So there's a range of benefits you can cover. You can imagine different types of cancer, for example, and on all these different options. You can tailor a specific plan going forward rather than just having a generic kind of plan. And that can be cost effective for you. And that's something we can help with. This type of cover is often taken out to cover a mortgage. But what about your family? What would happen then if, like I say, if you're the sole breadwinner and an illness came in? Yeah, okay, the mortgage is paid. But what about your shopping? What about your gas, your heating? What about things like this? So again, this is where we look at things in detail for you. I think finally on here, we've got the key threats of financial planning in your retirement. So there's 4 different types of money to consider here. Emergency fund. So the emergency fund is to cover core expenditure for a period of 3 to 6 months, generally kept in your bank account, generally immediate access. So this potentially would cover things like boiler repair, roof repair, things like that. Immediate, you need to pay immediate out to get things done. This is what this would normally cover. Short term, so potentially 1 to 5 years. So you could be saving for a deposit for a house, for example, or making a major purchase. Short term access or with a notice period. The third option is a medium term, generally 6 to 10 years. This is where you're looking to retain the power of your money, purchasing power of your money. So making sure that it's keeping ahead of inflation. And this could be potentially something for longer term goals like early retirement, for example. It might be potentially purchasing an additional property. It could be paying university fees. And then you've got your long-term plan. So 10 years plus, again, inflation proofing, longer term aims and goals, e.g. provision for retirement. So you might be considering thinking, well, what can I do to maybe retire early? So a longer term plan, should I pay more into my pension over a specific amount of time? Should I maybe redirect that money into an investment option? What would be the pros and cons of each different thing there? Should I look at protection? Should I be paying protection over a certain amount of time while I am working and building up funds? So we have what's called the accumulation phase, and this is where a member has surplus funding. So potentially you may have surplus funding on a monthly basis now. That money might just be sat in your bank account or in your savings account. So is there something you can do with that money now at this point that's going to help you potentially down the line? As a finance company, our remit is to beat the high streets. So I speak to members and they say, "Oh, Dan, I'm getting 4% at the moment with no risk," which is fine. That's okay. But we are aligned to beat that, if you like. So we work on a risk-based approach. So we have 5 risk levels. Super cautious. I don't want to take any risk with my money. So we have number 1, super cautious, and then we move up to number 5, which is high risk. Our super cautious approach would have to beat the high streets, otherwise there's no point in us doing it. What you've got, I suppose, with the advantage with that is that your money is invested, and because your money is invested, we are looking to beat inflation. It comes with flexibility, so you may be looking at thinking, well, I want to pay in on a monthly basis. As I've got surplus income every month, I want to use that money to pay into this investment moving forward. That then's going to give me options for potentially retiring 5 years early, for example, or 7 years early. And we have then what's called bridging the gap. So potentially your state pension might come in at 67. You might want to finish work at 60. The gap there, these types of medium to long-term investment opportunities will allow you then to take an income tax efficiently to bridge that gap to achieve your financial goal of finishing work early, for example. So that's just one example there. But members get a bit nervous about investment and risk, but I think it's important to understand that with Quilter, for example, we're not a high-risk proposition. And I suppose the downside with that is you're never going to wake up the next day and think, "Oh my God, my investment has gone through the roof. I've made all this money. Wow, can't believe it." On the flip side, you're never going to look at your investment and think, "Where's all my money gone?" So we take quite a mild approach to investing. What that means in a nutshell is that if you are super cautious level 1, you're only actually risking 7.5% of your total fund value. If you was to go up to level 5, high risk, you're actually only risking 25% of the fund value. And what that means is that in any bad year, that is the maximum you would lose from your investment. And that generally happens 1 in every 20 years. Unfortunately, we've had two occasions recently with COVID-19 and Russia invading Ukraine had dramatic impacts on the stock markets, and those 2 events actually caused that 1 in 20 year period to happen twice. But the funds recovered within 6 months. So this is the key to understand that you're not risking all your money, and members had their money back within 6 months, and then the growth started again from there. So we use investment analysts, and we basically stress test investments for those particular things, those particular events to happen, for example. So it's worth speaking to us if it's something you're considering and it's something you want a little bit more from your money. Have a chat with us and we can talk through different types of investments. We can talk through different types of risks. But in essence, you're not risking all your money. I think that's the main thing there. Inflation. So what is inflation? Well, a sustained increase over time in the overall prices of goods and services in an economy, usually expressed as a percentage that shows the rate at which prices increase over time. So what does this mean to you? What does it mean to your retirement? Well, inflation means that with the same amount of money, you will be able to afford less in the future. As a result, the higher rate of inflation, the less you'll be able to afford. And this is what we're saying about holding money in your bank account. With inflation rising year on year, are you getting are you getting the maximum returns by having money in a low interest deposit account, for example? Inflation is taxation without legislation, and it's a big concern for most people at the moment, especially with what's happened recently. We've seen sharp rises in inflation in the UK in the past few years, especially during the pandemic period there. Inflation can change a lot, meaning that it's important to protect the value of your money and secure your financial future. One of the main inflationary measures we have is the consumer price index. So this graph shows the consumer price index, showing the percentage and the annual change in the price of typical goods that you might buy every day. As you can see there, the spike over the COVID period. So how does this actually impact your money then? What does it mean? Well, the higher rate of inflation, the less your money in the bank will buy you. So for example, here, the effect of inflation on £10,000 over a 20-year period. So if you put £10,000 in your bank account in 2024, say if there's a moderate rise in inflation of 3%, in 20 years' time, your money is literally reduced nearly by 50%. The purchasing power. You would still have your £10,000, but you'd only actually be able to buy £5,537 worth of those goods what you could have bought at this point in 2024. So basically what that means is that your purchasing power is eroding through inflation. And this is the importance of maybe getting your money invested, because investing efficiently and effectively will not allow this to happen. It will stave off inflation. So it's important to invest for the long term. We generally say a minimum of 5 years to invest. That doesn't necessarily mean that you're locking your money away. We don't lock people's money away through investing. We have flexible investment options at Quilter. But we generally look for a minimum of 5 years, and this is for this purpose here is to kind of ride out the fluctuations in the markets. There's always something that's going to impact investments. Anything that happens generally globally of significance will impact the stock markets. And as you can see here, over time, different things that have happened. Subprime mortgage crisis in 2007. The Chinese stock market crashed in 2015. The coronavirus pandemic came into effect in 2020. If you've got money held, or if you've got money invested, I should say, what you will see is peaks and troughs. We now provide apps for your phone or for online. And you would see it on a day-to-day basis. Your investment will rise and fall, which is normal. It's understandable. But basically what it means is that no matter what major event is happening throughout the world, if you're invested efficiently and professionally in the stock markets, the power of your money will remain strong. You can see what happens with cash. You can see the effects of what happens with cash through these major events. Same with bonds. But the stock market is the prime place for your investment to stave off inflation. And that's because investors are making decisions on a day-to-day basis to take into consideration what's happening globally within the markets. So this is a real plus for you going forward and for your investments. So as an example, an investment of £10,000 in the stock markets would have grown by 1,000% over an investment period of 30 years. So if you would have invested £10,000 30 years ago in the stock markets, it would have been worth 110,000 30 years later. So protecting your wealth with professional advice. So considering the tax rate payable in retirement is now ever more critical. So there are plan changes, obviously, that there are rumours going about at the moment. No one is 100% sure what's going to happen except for Rachel, so we're just waiting to find out what's going to happen. But basically what we're looking at here is the pension commencement lump sum, or PCLS. This is the maximum amount you can take out of all your pensions, in essence. So this is frozen at the moment at 268,275 in cash terms. This is called anchoring, and basically what that means is that at the moment your pension is anchored tax-free amount of 25% of the fund value. Its value will be reduced by continued stubborn inflation. So because this particular figure is fixed, yet inflation is rising, as someone who holds a pension, detriment over the next, year on year, inflation is rising, yet your lump sum in essence is anchored. That's going to put you at a detriment going forward. So any excess beyond that amount will be taxable at your highest marginal rate. So in a nutshell there, what we're looking at is potentially, rather than paying more tax at that point, is there something we can do to help you understand your lump sum, understand what these government changes are, and how we can do things moving forward to put you in a better position and help you save tax. So this just gives you one example with this anchoring of the lump sum in pensions. So the new landscape now asks us more challenging questions, especially for people with substantial pension assets. Should they take the maximum lump sum out? Is that something that they should be doing? So this provides certainty for individuals who would have otherwise been subject to a lifetime allowance charge, ensuring that no excess lump sum is generated. So again, we can analyse the pension with you, we can analyse the lump sum options, we can analyse the tax and the consequences of that. If 100% of the lifetime allowance is used, what are the downsides to this? What options are available? If they are at pension commencement lump sum maxima, any excess is taxable at their marginal rate, when benefits are taken as income. So again, it all comes down to how can I take my pension tax efficiently? So we look at things like re-enveloping, so basically utilising that tax-free cash. How can we use it effectively? We have to be careful with that because there are different rules and regulations around what you can do with the lump sum. We would be able to help you and show you what options are available there going forward. Very topical at the moment is inheritance tax. How would that impact your family going forward, your children, your grandchildren? Potentially, how is it going to affect you with your parents if your parents die? And as a result of that, their estate, in essence, is going to pay more in inheritance tax. That's going to have a knock-on effect on you and your family. So we do this inheritance tax planning, where basically we can look at things for you, and we can mitigate inheritance tax going forward legally. We use different things like trusts and bonds. And again, if that's something you feel that you would need support with, we can help you. At the moment, everyone's got an allowance of £325,000, and then they have what's called a residential nil rate band as well, which is up to 175. So potentially most people have got £500,000 in inheritance tax as an allowance. Anything over that, then for every 100,000 that you have, the government will take 40,000 off you. So it's it's very topical at the moment, and we can provide advice in this area. So financial product management is needed to protect your wealth going forward. There are a range of different products available. I think people are reluctant to get involved with it because they don't understand it, which is, which I understand. They are complex, some of the products, but this just gives you an idea of some of the products that we offer. We offer things like flexible ISA savings. This is different from your cash ISAs on fixed rates. This is more to do with an investment ISA. Again, it's based on your risk. We have junior ISAs if you're looking to maybe support for your children or grandchildren. We offer things like bonds. This generally tends to scare people. A bond, and I'm not putting my money in a bond. It's a fantastic opportunity for an investment. We offer onshore and offshore bonds, and it's something I feel that will become very prevalent moving forward, is understanding bonds based on the tax situation of the UK. So again, without going into complex details with it, if you feel there's something that interests you, we can help you. Pensions, investment accounts, personal pensions, we can support in these areas for you. This is just an overview. We do have many different types of investments. What we generally do is we would do a one-to-one with you. We would understand what it is you're looking for, what it is you're trying to achieve. We then go away, we do some analysis for you, and then we come back with different options for you personally to put you on the right path for your investment journey. So it's important to talk to us, and one of the advantages I suppose you've got is that you're associated with us. So all the due diligence, the background checks, and everything that's important with financial affairs has been taken care of in the background. We would, I would still obviously tell you to do your own checks on people like me and on Quilter. It's important to understand who you're dealing with financially, of course. But you have got this connection now with us, so it's important to take advantage of it. So what we've gone through in the presentation, and hopefully you've got a better understanding of what financial planning is and thinking about planning for your future. The essential steps obviously is your pensions, understanding your mortgage, what can I do with my mortgage, what mortgage options have I got, protection, really important to understand, and planning for what's ahead. And then obviously the avoidable threat to your plan, which is inflation, and how we can combat that and make sure that the value of your money stays strong going forward. The value of pensions and the income that they can produce can fall as well as rise, so you may get back less than what you've invested. Okay, so it's just maximizing your member benefits with us. We offer a free initial consultation. So if you want to speak to someone like myself and you've got something in mind that you want to do, we can establish what your goals are, what your needs are. We can go through a plan with you, and we can offer personalized analysis of your retirement plan. So you may have pensions that you build up, you don't understand them, or you may just not understand your current pension, for example. Get in contact with us, we can help you, and we can break things down. If your advisor finds that you need more guidance and financial advice, we'll give you a clear explanation about the costs and benefits. So in essence, what we do initially is we don't charge you. We're there to understand what it is that you're trying to do. We then give you options going forward. If at that point then, for example, you want me to work for you, that's when fees would come in, and we would explain fees obviously before any work was undertaken to make sure that you're crystal clear with what's going on. In terms of fees, we're a regulated UK company, which means we have to adhere to Financial Conduct Authority in terms of fair charging and consumer duty. What that means is that wherever you go in the UK for regulated financial advice, the fees should be the same. So we all use the same, we use a fee calculator basically. So that we're not ad hoc charging, we do things fairly, and we would show you how we would charge before any work is commenced. So again, just maximising your benefit with Quilter. I touched on this before. Basically, we offer what's called a cash flow forecast. The regulator is very keen for people like me to demonstrate why I've got to what advice I'm giving you and how did I get there. So we offer what's called a cash flow model. Basically, what that means is that we can look at points or financial points in the future for you, and we can demonstrate this via cash flow model. I'll give you a quick example. So you may be thinking of retiring in maybe 5 years or 10 years, but you're unsure how things will work out financially. What we can do is we can take the information, what pensions you've got, what savings you've got, potentially any investments that you've got, and then we can plug in these numbers into this calculator. Along with your goals and your plans, we look at things like your income, your expenditure. There may be some kind of different types of goals that you may have. You may be looking to pay a mortgage off, for example. So we put everything into the mix, basically. And then what we can do is we can show you, so we can say, okay, so if you retire in 5 years' time, this is how your financial situation will look. If you retire in 7 years' time, this is how it'll look. If you retire in 10 years' time, this is how it'll look. So we basically, we are providing you with a real appreciation of what your finances will look like before you get to that point. So this is very popular, and we do have examples we can send out before you commit to show you what it is. Basically a 50-page document, very in-depth, but very, very good, and it will help you make decisions going forward. Financial advice is structured, so we visualize the plan with you first of all. We then test the plan, and then we review the plan with you as well. Having a personalized retirement plans means that you could be able to retire earlier than you thought. So that's something to consider as well. The advice process is about you. So as a company, Quilter, what we want to do is we want to understand what it is you're trying to do. We want to help you plan it. We want to help you implement it. And then we don't just want to leave you with it. We want to refine this with you. So we want to work with you going forward year on year and making sure that you're on track. But that's fine. If there's any questions, I'm sorry we've run on a little bit there. If you want to arrange a one-to-one with us, please scan this QR code below.
Thanks, Dan. That was a really good overview of financial planning. We do have a few questions. I'm just conscious some people might have to leave. If you're happy to answer a few questions, that would be fine. If that's okay, as long as you've got time to do so. So I'll just sorry, go back. I did answer a couple of them. One is somebody saying, I've only been in my job with the civil service for a few years, and before that I couldn't afford to pay into a pension scheme. I'm in my early 50s. Is it too late to kind of make that up, or save for a decent pension?
No, it's never too late is the answer to that. And one of the good things about the pension that you've got is that you have got options to boost your pension as well. So there's a number of things we can look at, and we can give you some advice there as to how to boost your pension. This is a common concern for a lot of people, to be honest with you, but there are ways that you can boost the pension to help you get to that point and have the income that you desire.
Okay, is that something you could advise on in a consultation, or Quilter could advise on? Okay. Somebody else said, and it might be a difficult one to answer, but can you help me understand what the average civil service pension is? I heard that it's 10,000 and the state pension is 12,000. If that's the case, which is considered lower than the minimum amount you need for retirement, so how much would you need to save monthly in addition to civil service pension to live reasonably? Again, that might be on an individual basis. So, but do you have any thoughts on that?
It is. You're right. I don't think there's any average, to be honest with you. It's all on an individual basis. this is where the cash flow model comes in, because what we do is we look at you individually. We look at your finances in detail. We look what you've accrued so far, and then we can give you options going forward, looking at what income you feel you would need in retirement. Yeah.
Okay. Another one is clearly pension pots are linked to the market. They're linked to investments, which is what you explained earlier. So is when you're making withdrawals, is timing key? I mean, unless you really have no choice, I presume you wouldn't. I think this is that you wouldn't withdraw when the market is at an all-time low, or is there a way around that? Or
There is a way around it, and to be honest, it is the right way to think about it. Taking money out when the investments is dropped is not ideal, to be honest with you. Again, this is where it's key, I suppose, to work with a finance professional and have that relationship. Because what we can do is we can look into the best times to take the money out for you, and we can
yeah,
come up with a plan for you as well. There's a lot of flexibility out there at the moment as well. So sometimes it's best just to hold off a couple of months,
yeah.
while things are happening, and then once it's settled down, then it's the right time to take it out. So we can support you with that. Yeah.
Okay. Just another question on whether you've got any views on equity release as a means of generating cash in retirement. Somebody's heard that it's not necessarily the best financial deal. Yeah.
Yeah, I mean, I'm qualified with equity release, and I think it does get a lot of negative press, if I'm honest with you, because of how it affects things going forward. Potentially, what it's doing is it's diminishing the estate value that's left to your beneficiaries, potentially.
Yeah.
So, but sometimes it can be a real positive, and it can be a really good option for you. So if you live in a property, you own your property on your own, for example, you've got no beneficiaries, you feel that there is an income shortfall, then potentially there's different types of equity release options available that might be suited personally to you, and that would work for you. So again,
Okay.
that's something to speak with us with, and we can give you the best options going forward.
Okay. And then again, might be a difficult one to specifically answer, but at what rate does your pension grow by if you don't take the lump sum from it, i.e., if you invested the lump sum instead of taking it once you've retired?
Yeah, and it's difficult to say growth rates, but basically we have a remit as an investment company. We look to beat the high streets. So at the moment, it's about 4% for non-risk savings in the high street, for example. So as an investment company, if you're putting your pension with us on the lowest risk, for example, we would look to obviously beat that. Otherwise, there wouldn't be any point in us doing it. So
Yeah.
it's hard to say, but generally, the lower the risk, we have. I mean, at the moment, I'm just trying to think of our returns. I think our lower risk returns over the last 12 months is about 6.5%,
Right.
and
Yeah.
then for each level that you go up, 1, 2, 3, 4, 5, obviously, then you would see a higher return rate.
Yeah. Okay.
Um, but we aim for steady growth. We're not looking for this quick return straight away. Ours is based on gradual growth. That's what our remit is really.
Okay. Okay. That is the end of the questions. So thank you very, very much for providing us with that presentation.
You're welcome.
For those of you still with us, just a reminder that this has been Talk Money Week, and you can access recordings of the webinars that we've run throughout this week. They will be available on our website, all except the presentation from GamCare, which was on gambling harm. That unfortunately there won't be a recording for that. But if you go onto our website, click on the help and advice section and the webinar section, you'll be able to access recordings there. If you do want to find any more about the charity, what we do, how we can support you, then go onto our website, which is www.cfcs.org.uk. There's a wealth of resources on there. There's information about the financial assistance that we can offer, and also our money advice and guidance service, and our caring health and wellbeing services, together with access to lots of useful resources. So do take a look at the website for further information on what we offer. Thank you very much for joining us this morning, and that's goodbye from us. Thank you.
Yeah, thank you. Thanks, guys.
Thanks, Dan.
Take care. Bye.